wrap up with one table on valuations. We've talked about valuations a number of times over the past few years. This is another way of looking at valuations in the S&P 500, comparing current valuations to their late 1990s corollaries. So, for example, when did we hit today's price earnings ratio in the late 1990s? There are a lot of connections between the current market and the late 1990s market, the AI boom today versus the internet boom of the late 1990s. Well, where are we today in valuations relative to valuations at that time? So you can see if this is for the S&P 500, the price earnings ratio, and we're using Bloomberg data here. Price earnings ratio currently stands at 26.0. We hit that for the first time in the late 1990s in November of 1998. So there was still some room to run at that point. We did have a correction in 1999, and then the bear market finally began in March of 2000, but there was some room to run after the price earnings ratio hit 26, which is where it is today. The forward PE, the 12-month forward-looking price earnings ratio, currently at 22.4. We hit that in the late 1990s for the first time in July of 1998, the summer of 1998, just before that very deep correction fueled by the Russian ruble crisis, the emerging markets crisis in 1998. So again, a lot of room to run after we hit that valuation for the first time. The CAPE, the cyclically adjusted price earnings ratio, the long-term price earnings ratio, currently at 39.9. We hit that in the late 1990s in January of 1999. So a little bit more than a year before the market finally cracked and the bear market began in March of 2000. But then let's look at the price to book ratio. We're at 5.5 today. We never hit 5.5 in the late 1990s. We got a little bit over 5 at one point, but we never hit 5.5. So we're already above the late 1990s peak there. Same story for the price to sales ratio at 3.4 currently. Never hit that ratio in the late 1990s. And then finally, the Warren Buffett indicator. So this is the indicator that Warren Buffett said was the best valuation indicator. This is market capitalization divided by GDP. We're currently at 230% market cap to GDP, 230.0. We never got close to that in the late 1990s. In fact, have never gotten close to that historically, at least in the history for which we have GDP data going back to the 1940s. In the late 1990s, we peaked actually in early 2000, early in the year 2000. We peaked on this metric at 162.6. Here we are at 230.0, well above that late 1990s, early 2000s peak. And keep in mind that these numbers are based on third quarter 2025 data. We don't have fourth quarter GDP data just yet. We don't have the Fed's flow of funds for the stock market capitalization data just yet. So by now, January of 2026, the number is almost certainly higher than 230. So some valuation metrics, some headline valuation metrics, still not quite to their peaks from the late 1990, still in 1998, 1999 territory, still at a point, at least in that cycle, where the market had room to run. But some other important valuation metrics are already above, some well above their peaks from that era. So again, reflecting a fragile market. It's been a strong market, but still a fragile market here as we enter early 2026.
To watch this month's complete analysis and receive daily updates directly to your inbox, become a member at cycleframework.com.